So far this semester, we've covered two main types of financial instruments: equity, so ownership interest in companies, and debt. Now we're going to cover very briefly a third type of financial instrument that's very important, and that's derivatives. And we're going to start derivatives with option contracts. And then we're going to talk about futures and forwards, which are very similar. All right, so let's start with options. Options give the buyer of the option the right, and that's very important, the right, but not the obligation to buy or sell an underlying asset. And this underlying asset can be pretty much anything. So something with a varying level or price for a certain price. So the transaction will happen at a fixed, previously determined contractual price, which we call the strike price, by a certain date, which is a sort of fixed date, and we call that expiration date. Okay? So this right but not the obligation. So this is a contract that gives the buyer the right but not the obligation. That's what gives the name to this type of derivative option. That's where the name comes from, right? The right but not the obligation. So the buyer, the owner of the option, has an option to exercise or not, depending on the circumstances. All right. So in terms of definitions, one thing you need to be really aware of is the two types of options: call options and put options. And call options give the buyer the right to buy the underlying asset at a fixed price, and the put options give the owner of the option, so the buyer of the option, the right to sell the underlying asset, whatever that asset might be, at a certain price by a certain date. And this right but not the obligation, a very important implication of that is when you own a contract, a piece of paper that gives you the right to do something, but you're not actually obliged to do it, that's a very valuable option. And as a result, these contracts will have a value, meaning that if you want to buy them, you're going to have to pay something to get into these contracts. So the buyer of these, whether call options or put options, this very valuable right will require a cost, and we call that the premium. The option premium. So there is a certain value attached to it. And then you can buy the option, and before exercise, before the expiration date comes, you can actually sell it. And it's the price, depending on what's happening in the meantime, can fluctuate. The price of the option, the value of the option can go up or it can go down. Okay, so that's what options are. Let's see an example right away. AAPL. So this is an option written on a stock, which is very common. It doesn't have to be. Options are written on many different things, as long as there's, again, a number that fluctuates, a level that fluctuates, and stock prices certainly satisfy that condition. You can write an option on that. So the stock options are very, very popular and common. So this is an option written on Apple stock. January 2023, that means that's the expiration date. And in monthly options, the convention is that the expiration date is the third Saturday of the month. It's not too important. You don't need to worry about that. But what this means is this option will expire by the third Saturday of January 2023. And that means the last day you can trade this, buy it or sell it, will be the Friday before, the day before that Saturday. So the third Friday of the month is the last day when you can trade these before you have to make a decision to whether exercise it or not exercise it. The next number, 120, is the strike price of the option. So that's the price at which you are agreeing to trade the Apple shares, each Apple share, on or before the maturity date. Okay, trade, but what type of trade? Buy or sell? That's determined by that call option. So this means you have the right, but not the obligation to buy a share of Apple at $120 per share. Okay, so that's that strike price is telling us that we are agreeing to buy this if we want to, if it's advantageous to us, and if not, we're not going to exercise. That's our option. Okay, so this is a call option. And next number we see is the premium. Again, it has a value, right? Right now, this option is trading at $21.70. So by paying $21.70, you can buy this option that gives you the right to buy Apple shares at $120 per share on or before the third Friday of January 2023. All right. So some additional important things here now about this option. So this is the call option, giving the holder the right to buy. So one thing that's important is each of these contracts will actually be written on 100 shares of the underlying stock. So these numbers that you see, 120 and the premium 2170, these are per share, but actually each contract is a bundle of 100 shares. So when you actually want to buy this, you have the right to buy 100 shares of Apple. If you buy one option contract, this is giving you the right to buy 100 shares of Apple, and you're going to pay 100 times 2170. So this whole contract will cost you 2,170. All right. So again, each contract is 400 shares. Must be exercised on or before. So the third Friday of that month is January 20, 2023. Okay. Now, when would you want to exercise this? So you have the right, but not the obligation to exercise. Well, when would you want to exercise it? When would it be advantageous? You're going to want to buy shares of Apple at 120 if and only if Apple is trading at a higher price at that time when you decide to exercise it, right? Otherwise, it's not advantageous for you to exercise it. You will not want to pay $120 for each share of Apple if it's trading at 110, right? Because if you want Apple shares, you can go buy them in the market for $110. But if Apple is trading at 130, 140, then yes, it would be a great deal to exercise this option and buy them at 120 per share, and then you can immediately turn around and sell it in the market for 130, 140, so whatever is trading at. So options, a call option specifically, will give you a positive payoff. If the stock is worth more, the price is worth more than the strike price of the call option contract. So strike prices here is 120, so this option will give us a positive payoff if Apple is trading at a greater price than the strike price of the option. Okay, so this will give us a positive payoff, which is one we will want to exercise. Otherwise, we're not going to want to exercise it. And the option is worth $21.70 per underlying share. So because it's written on 100 shares of the underlying, if you want this call option contract, we would have to pay $2,170.